Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, and welcome back to the Finance Garage, where we break down money, the economy, and your financial future in plain English. As always, Jonathan Wu here, Senior Financial Advisor and Principal at the SW Group. And today, we're unpacking the 2025 federal budget, which was handed down this week by Treasurer Jim Chalmers.
Speaker, this budget builds on the progress that we have made together. It's a plan to help with the cost of living, with 2 new tax cuts and higher wages, more bulk billing and more help with electricity bills, cheaper medicine and less student debt. It's a plan to build Australia's future, with more homes, new investments in skills and education.
Now, we all know budget night is usually full of jargon and headlines and, a really nice half-hour speech that Jim, or whoever the treasurer is, puts forward his case to the country. Now, what makes this budget announcement quite special, I guess, or unique, is that this is Treasurer Jim Chalmers' 4th budget, which is very rare given the fact that federal governments run on 3-year terms. Now, it's anybody's guess, but shortly, Anthony Albanese will be seeing the Governor-General to basically announce that he is basically dissolving Parliament and looking to launch the next election. So it was without doubt that this budget was truly a budget in preparation for an election. With all the jargon and the headlines that we had to listen through the last couple of days, this episode is really looking at what actually matters to you, your family, your wallet, and your plans. So whether you're saving for a house, paying off help debt, running a business, or just trying to keep the lights on, we've got you covered. As a backdrop, let's have a look at why this budget matters. Now, number one, as I said, we're going into an election campaign very, very soon. And unfortunately, from a balancing the books perspective, we are back in deficit. Now, obviously, we've got uncertainty everywhere. We've got trade tensions, especially with Donald Trump launching tariffs in the last couple of weeks. And for those of you that didn't listen to my last episode talking about how tariffs work, I encourage you to tune into that one as I break down where the risks are. We've got a volatile global economy as a result of this, and the inflation risks, while broadly under control, could lurk up and shock us because of these trade tensions. Now, Treasury is expecting GDP growth to pick up from 1.5% to 2.25%, and unemployment will peak at 4.25%, which the government announced is actually better than what the forward estimates were earlier. And the government is really walking a fine line here, because they're, on one hand, continuing the easing of cost pressures, which is clearly the election pitch, but they need to be very careful in not stoking or really triggering inflation to take off again. So if you think about it from a real world perspective on a household budget, think about you managing that budget, and after a tough year, you want to help the kids with school expenses and also fix the car, take a holiday, but you can't afford to max out the credit card again. So that's essentially what this budget is doing. Now, the first thing which has been quite controversial, and obviously it is, targeting middle-class Australia in order to buy votes in the upcoming federal election, is that Jim Chalmers last night announced a new wave of tax cuts.
Speaker, tonight the government is proud to be delivering more tax relief. Every Australian taxpayer will get a tax cut next year and the year after to top up the tax cuts which began in July. Yeah. This will take the first tax rate down to its lowest level in more than half a century.
Now, that tax cut's really targeting the lowest end marginal tax rate, and from July 2026, they are looking to take off 1% off the current 16% marginal tax rate, so taking that down to 15%. And then from July 2027, take another 1% off to bring that down to 14% marginal tax rate, which is that first bracket over and above the sort of $18,000 tax-free threshold. Now, that net result for someone, maximizing those benefits is that in the 2026-27 financial year, there'll be about a $2,229 tax saving, and in the 27-28 financial year, they'll increase to $2,500. So that looks to be roughly about $50 a week back in your pocket. Someone on the average wage, which is around 79,000 Australian dollars, will get a $2,190 cut by 2027-28 financial year. If you've got a young couple that are both earning around $80,000, that is equivalent to about $4,300 a year save, which obviously is a big deal. They could go to childcare, go to groceries, or even a holiday fund. Now, from an advisor, one of the things that you need to now reconsider is the pre-tax super strategies, meaning concessional contributions vis-a-vis your employer SGC, which obviously you don't have control over, any personal contributions, which are personal concessional in nature, so those ones that you're claiming a tax deduction for, or salary sacrifice, may not be as attractive for low-income earners anymore, especially when we get to that July 2027 mark, where the marginal tax rate, or the first marginal tax rate above 18,000 and below 45 is 14%. If you contribute money as a personal concessional contribution to super, you have to pay 15% contributions tax. So you might be better off contributing money non-concessionally, and that also has an added benefit that when it goes into the superannuation account, that actually tops up your tax-free component, not your taxable component, which has got other adverse consequences to your loved one and beneficiaries later on in life. And I might look to do another podcast in a couple of months to discuss this very point. Now, one of the things that was quite welcome, which, arguably stopped the RBA from cutting rates sooner than they had already had, was the energy bill relief. It's small, but timely. Households are still feeling the pressure, and households will still get an extra $150 rebate from July 2025 on top of the current $300. Furthermore, small businesses are also eligible. And if you think of it from a real life perspective, it's about covering a quarter of your winter energy bill, or most of your spring air conditioning bill as well. Is it helpful? Yes. Is it game changing? Probably not. But when everything adds up, each small wins matter. So if you combine the tax cuts, if they pass royal assent, and if you then compound that with energy relief, it does add more money. But you also remember that if it adds more money and you end up spending that money, that also stokes inflation, which is what the government doesn't want to trigger. Then we've got a healthcare overhaul, whereby the government is trying to get more free GP visits up and running. So from November 2025, Medicare rebates go up. The current Medicare rebate is $42.85. This will go to $69.56 in the cities, and then up to $86.91 in remote areas. The government's main goal with regards to this is to effectively try to make 9 out of 10 GP visits bulk billed by 2030. You would have noticed that, as it stands today, people on concession cards and children under 16, the government actually pays a top-up bonus to doctors that bulk bill these sort of patients, and therefore that's why you see quite a number of practices following in that same way. So hopefully with the rebates going up, it will encourage more GPs to bulk bill. Furthermore, there's going to be new urgent care clinics to be built. There are 50 more that are coming, with a total of 137 nationwide. The government has pitched this as, something like 80% of the population will be no more than 20 minutes drive away from a urgent care clinic, which will hopefully reduce the pressure on the emergency rooms, and that will be completely bulk billed as long as you've got a Medicare card.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
If we then turn to PBS medicines, which have dropped over the last couple of years, which is obviously welcome news for a lot of people, the government is proposing that the PBS medicine cap will actually go down from the $31 or so as it stands today, down to $25 a script from January 2026. This obviously doesn't affect pensioners because pensioners are staying at $7.70. But if you're not a pensioner, if you've got 3 prescriptions per month that are under PBS, this could save you over $240 a year, which is quite welcome. There's also been some money allocated to the Women's Health Boost, so we're looking at 150% increase in rebates for IUDs. Menopause assessments and hormone therapies will now be subsidized, and so the government and Treasury estimate that about 150,000 women are expected to save a couple of $100 per year on the back of this. Now, if we then shift the focus to young people, there is a win. And again, this is probably targeting the lower or younger demographic, or those people that have just started to enter the workforce. Student debt is getting a cut. Now, we all know in the US, the student debt issue is a very, very large one. And it's meant that a lot of young people simply can, not afford many things later on in life because they almost spend their entire lifetime paying down debt. So Jim Chalmers is proposing a 20% HELP debt reduction from June of 2025, effectively wiping out 20% of a student's debt from the HELP system. So on average, they've worked out that a $27,600 debt to HELP, $5,500 will be instantly wiped out. They've also increased, or they're looking to increase, the new repayment threshold, which is currently $54,000, and they're looking to increase it to $67,000. And you only pay on income above that threshold. So as a real world takeaway for a young professional trying to save for their first home, this is big. You'll have more room to breathe in those early working years to basically save up for a home or other large capital expenditure. But the offset to that is smaller repayments could also mean more interest over time. If you remember a couple of years ago, because HELP debt is actually indexed to inflation, we saw a scenario where that year, I think it was 2022, when inflation hit 7%, everyone's HELP debt actually went up by 7% in that new calendar year or financial year. I couldn't quite remember when it gets reset. We've got some further reform on the childcare side. We all know that Albanese, when he was elected, he basically said childcare or universal childcare for all, and a significant increase in the income threshold for a family, so that anyone that is earning under $533,000 a year as a family could get, a higher rebate level for childcare and be further subsidized. From January 2026, Chalmers is proposing that as long as you earn under $533,000 a year as a family group, you'll get guaranteed 3 days of subsidized care per fortnight, regardless of activity. There was this activity test, or there is this activity test at the moment, which is largely quite confusing. If this gets through, the estimated savings for someone on $90,000 income, they'll be about $11,400 a year better off. If they're on $120,000 a year, they'll be about $10,600 better off. And if they're on $140,000, they'll be $10,000 better off. for many families, this actually, the practical implication is that it removes the crazy loop of you can't work unless you have childcare, but you can't get childcare unless you work. And this was that activity test referred to earlier, which is genuinely a little bit cumbersome, and it's harder to then qualify. We've then also got a little bit of better news on the shared equity scheme that the government announced a couple of years ago. And the shared equity scheme now will open to existing homes as well, as opposed to just new build. Government will chip in 30% of existing home prices and 40% of new builds. There are new income caps in place. So for singles, it'll be $100,000 a year. For couples, it's $160,000 a year. The Sydney cap on the price of the property that you purchase will be $1.3 million, and Brisbane will be $1 million. The only catch, though, is that the government is only allowing 10,000 spots a year to be open. So it's a good idea, a bit limited in reach. They're trying. We all know that housing affordability and rental affordability as a consequence of that is a large structural issue in Australia. So if you're keen on this shared equity scheme, get in early and talk to a broker. We've also got some disaster relief, obviously, for those suffering from the recent impacts of Cyclone Alfred up in Brisbane. There's going to be 13 weeks of income relief, which is otherwise known as a disaster recovery allowance by the ATO. That is $1,000 lump sum per adult and $400 per child. Applications for that open until September 2025. And probably the pro tip here is don't wait. These payments are there to help during the recovery, and they're actually not taxable. Small businesses have a few things up their sleeve that they've announced. Now, one of the unfortunate things that we saw actually Jackie Lambie, who's an independent senator from Tasmania, criticised the government for last night or this week after the budget was released, that the instant asset write-off is not being extended. And that instant asset write-off, for those of you that were following, was to encourage businesses to effectively purchase large-scale assets, machinery, equipment, and to be able to write it off as a tax deduction in one go, as opposed to straight-line depreciation that's required on most forms of equipment. So that's not included as part of this new budget. What they are proposing, though, is that there are some energy grants up to about $25,000 to help your business become more efficient from an energy consumption perspective. They're looking to pause the draft beer tax to help pubs and breweries. They're also looking at, and this is probably a bit of a controversial one, is they're looking to ban non-compete clauses from 2027 for workers earning under $175,000. Now, the government argues that this will increase job mobility and potentially wages, especially in the technology, healthcare, and trade sector. Obviously, this is sort of, to a certain extent, fraught with danger. Even though it does allow job mobility, it also then has a double-edged sword for employers in terms of what other ways do they have in order to protect their own business. There's also a little bit in it for the franchising sector, so there's more, ACCC enforcement and protection on unfair contract terms from franchisees. With superannuation, which is obviously what we focus on a lot as advisors, there's nothing big, but there are some changes that were legislated before that will come into force shortly. Probably the biggest one is the super guarantee increase, or the SGC, is increasing to 12% from July of this year. There's also not going to be any extension to the deeming rate freeze, which was enforced during COVID, so that's likely to rise. So that is the assumed income on financial assets for the purposes of working out your eligibility to the age pension if you're using the income test. And there has been no further discussion on the Division 296 tax, which effectively targets super balances over $3 million, because that's still stuck in the Senate. It is something that we're watching very carefully, especially for our clients that are either at $3 million for super or getting close. So wealthy retirees should be prepared for the eventual changes on taxation for these large super balances. So wrapping it all up, This budget wasn't all that flashy. It's functional, it's really targeting the upcoming election. There's some relief where it matters. There's cost of living, student debt's probably a bigger one. There's a bit of further extension to the childcare subsidies, but not really a lot of spending. It's probably a smart move with an election around the corner, and obviously, as I said before, they don't want to be in a position where they really trigger off another new wave of inflation, because we saw how many rate cuts it took to actually bring inflation back under control. So the three key takeaways I would say reading from this week's budget is plan early. So there are tax cuts and help changes. They're not immediate, but you can prepare for it. Check your eligibility, whether it's from the childcare incentives or the disaster relief. There is some money on the table to help you. And third of all, always talk to a pro, whether it's your financial advisor, accountant, mortgage broker. The right guidance can turn any budget policy into a practical advantage for you. And we're always here at the SW Group to help anyone who is in need of advice. So thanks for taking the time to tune in for the Budget 2025 update. As always, happy to take feedback at jonathan.wu@simonwu.com.au. And as always, please remember to listen to the disclaimer at the end, and always happy and keen to take your feedback. So till the next one, see you next time.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SW Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.